In October 1907, JP Morgan locked the most powerful bankers in America inside a room and refused to let them leave until they agreed to save the financial system. In this episode, we're going inside Morgan's library at the height of the panic of 1907. Who was in the room, what they were debating, and how one man forced Wall Street to act together. This is one of those moments where finance stops being about spreadsheets and numbers and becomes purely about human psychology. After the stock market rescue that we discussed last episode, the system didn't heal. It paused. We stopped the floodgates from bursting wide open, but there were still major problems in the financial system. And we go back to trust companies that we talked about earlier in this series. Again, trust companies are similar to banks, but they operate with less regulations. They take on bigger risks. They have lower required capital that they have to keep on hand. And so in good times, they typically perform better than banks, but in bad times, they perform worse because they take bigger risks. Just like anything in our economy, with more risk comes more reward and vice versa. So the trust companies, they were still bleeding deposits. We know from a previous episode, Knickerbocker Trust had to shut down because of bank runs. It was a confidence issue. People heard rumors that the bank might be running out of money or might be insolvent, and Mr. Hines, who we learned about through his attempted cornering of the copper market that set this whole thing off, might be associated with the bank, and therefore, let's get our money out of there before it's all gone. Let's get the money and run, as they say, and that took Knickerbocker out. So banks were still hoarding cash, right? We're in a crisis. And most importantly, no one trusted anybody else's balance sheet. And in a leveraged system, that's fatal. In our banking system in America, we use what's called fractional reserve banking. And that's the system that allows us to borrow money, right? If a bank brings in $10 of deposits, it can lend out $100. And that's great. It helps our economy expand, helps GDP to expand. But it also means that if everybody wants their money all at once, it's not all there. It's out there. There's a famous scene in my favorite Christmas movie, and my dad's favorite Christmas movie, It's a Wonderful Life, where there's a run on the main character, George Bailey's bank, and he's talking to the customers, and they're asking where their money is. And George goes, well, it's in the house right there down the street. It's in your neighbor's house. It's in the wool business down the street. And what that means is they've taken the money and they've loaned it out to the community and to local businesses to keep the local economic engine running. So the money's not just sitting there in a vault. Like we said, in a leveraged system, when everybody panics at once, that can be fatal. Once trust disappears, credit disappears. That's what money in banks is at the end of the day. It's myself or you, we're giving the bank our money, letting them lend it out on the understanding that we can come get it back when we need it. But if we all come back at once, that's where problems can occur. So now attention turned to, instead of Knickerbocker, it turned to the Trust Company of America. This was not a small institution. It had roughly 60 million plus in deposits. That sounds like not much today, but that was a ton of money in 1907. They had thousands of clients and they had deep connections across the financial system. They had their hands in just about everything. And they were experiencing, much like Knickerbocker, heavy withdrawals, bank runs, in other terms. And the key question is the Trust Company of America actually insolvent or just illiquid? Because that answer, as we know, when it comes to JP Morgan, who's pulling the strings here, that is the key question that determines everything. And again, illiquid just means I don't have liquid cash at the moment. If everybody comes in on a bank run at once, I don't have the liquid cash to give to them. Insolvent means I'm underwater. I'm not worth saving. In the context of like your personal finances, this would mean not only do you not have liquid cash, but you have a negative net worth. You can't sell off assets. You can't hold assets and wait for the market to hopefully recover, you're insolvent. You're a carcass as far as financial terms are concerned. You already know our main character here, JP Morgan. But what matters in this instance, in this critical moment for the US economy, is his mindset. JP Morgan believed in hierarchy, and he believed markets needed discipline. And with that, he believed weak institutions should fail. And we could learn a lot from JP Morgan nowadays. It seems in so many cases, we deem everything too big to fail. We bail out companies that frankly should be, in my opinion, left to die. The most famous example is 2008, 2009, the great financial crisis. Now, in that case, one could certainly argue that the system was too big to let it fail. And we had to bail out those banks, as backward and wrong as it seems, because they were the ones that, that there's varying opinions on this, but they created much of the crisis. And now we're bailing them out, and they're not paying a price for what they did in putting the global economy at risk. But back to our situation in 1907. Morgan believed weak institutions should fail, and we saw that. He practices what he preaches, and he let Knickerbocker Trust fail. So his ethos, he was not trying to save everyone. He was trying to save the system. And a core belief of his was that saving companies that are insolvent or companies that aren't worth saving, that just poisons the system. It's a classic case of if we throw a bunch of money at trying to save a business like Knickerbocker Trust, for example, who he determined was insolvent, that's the definition of throwing good money after bad. So we waste more money and resources, and we end up in the same place anyway, but actually worse off because we've spent money trying to save something that's already dead. So the men in the room here, as we're trying to save the American financial system, some big players. So the first one we're going to talk about, his name is George F. Baker. And Baker ran First National Bank, which was at the time one of the largest banks in the country. And his background is fairly traditional. He rose through the traditional banking system. He's deeply risk averse. Okay, he's focused on preserving capital. He's not chasing returns. This is your buddy who has a 60-40 portfolio, time cost averages every month. He's not chasing alpha. He believes slow and steady. He's very conservative. His bank holds massive depositor funds. And again, his whole career was built on one principle. And this was later on in the 20th century. This is Warren Buffett's first principle. Don't lose money. And in a panic, that instinct can go to extremes. So his default move for George Baker is to hoard cash, protect his own bank, and basically do nothing when it comes to saving the Trust Company of America. So that's George Baker. Another character here, his name is James Stillman. And Stillman ran National City Bank, which would later become modern day just Citibank. CITI. At the time, it was CITY Bank. And he's very connected, both politically and to bigwigs in the business world. And one huge name he's connected to was the Rockefeller family, who's had their hands in countless different business interests. But National City Bank was heavily intertwined with their finances, and he had deep relationships with William Rockefeller, who was John D. Rockefeller's brother. The ties extended, these weren't just business relationships, the ties extended socially as well. So Stillman sat at the intersection of banking, oil, and even political influence. So he wasn't just protecting his bank, he was protecting a wider network of power and capital across various business interests in the US. Then we have Jacob Schiff. He's one of the most interesting figures sitting in this room. His background, he is German-born and immigrated to the US and became head of Kuhn, Loeb and Company. They financed railroads, industrial expansion, and international loans. They have their hand, this is a big bank. They have their hands in a lot of areas, and railroads, again, during the time, railroads, there's been countless comparisons to what was happening with railroads back in the early 20th century and AI today, just haphazard, throwing money everywhere, overinvestment, created a huge bubble. I don't know if that's what's going to happen with AI or not, but it was completely disorganized and people were just throwing capital everywhere when it came to building out the railroad system in the US. But back to Jacob Schiff, he was known for intellectual independence and he had some skepticism of Morgan's dominance. He's not a huge fan of the fact that JP Morgan just keeps showing up in these scenarios and seems to have his hand in everything. He's kind of the Geppetto of the US economy. And he has, again, Morgan has no official powers granted to him by the US government or anything like that. He's just kind of the de facto guy. When something like this happens, everybody looks and JP Morgan is the leader. For Schiff, unlike Baker, he wasn't just defensive. And unlike Stillman, he wasn't just tied to one industrial empire like the Rockefellers. He was thinking more in terms of system-wide outcomes and his own and his bank's long-term positioning, because he's got his hands in railroads, industrial expansion, and even international loans. So these men did not agree naturally. They had different incentives, okay? They have different risk tolerances, and they have different power bases. This is why this meeting mattered and why someone who could come in and get everybody working together was going to be the key here when it came to saving the US financial system in this crisis. So let's walk through this one step by step. If the Trust Company of America failed, that means 60 million plus of deposits are frozen, which what happens then? First thing we know is when you tell somebody that they can't get their money out, what do they want to do? They want to get their money out. When everything's good and everybody's calm, we'd love to, leave our money in there. We'll earn interest on it. We'll earn returns. The second you tell somebody they can't have something, they want it. And that effect is amplified when it comes to money. So then depositors start panicking. Runs would for sure spread to other trusts. We've already seen this as the panic has spread through the financial system, from banks to trusts to the stock market. This stuff is all so deeply intertwined back then. So what else would happen if the Trust Company of America failed? Trust companies would begin failing in sequence, because each failure, starting with one as huge as Trust Company of America, each failure increases fear and withdrawals accelerate, okay? Banks start to face second-order pressure, depositors withdraw more cash, and then what happens next? Banks start calling in loans, okay? If all the depositors are rushing in to get their cash out, the bank, they go, we don't have this cash right now. So what have they done? They've lended the cash out to brokers who want to allow people to buy stocks on margin, people giving out business loans, home loans, etc. They say, hey, we need our cash back because all these depositors are coming. You can imagine what happens there. That is forced selling. And we know anytime there's forced selling, people are, forced to sell at lower prices than they would in a stable market. And so call loans get pulled from brokers. Remember those call loans we talked about? Those are very short-term loans, usually at low interest rates. In a crisis, we touched on this in a previous episode. Some of those loans jump to 100% interest rates. But those call loans, they're structured in a way where you can, as the name says, call them due at any time you want to. And so then the brokers who've got these call loans, they have to liquidate stocks. What does that do to stock prices? Stock prices collapse. Then the stock market falls sharply. Margin calls increase. More forced selling. It's just a doom loop, okay? Then we have falling prices, which leads to more panic, which leads to more withdrawals. And remember this cycle, you've got the banks that are lending money to the brokers, and then the brokers are lending the money out to the speculators and investors who are buying stocks. And it's all this circular arrangement, and it's all so tied together. The bottom comes out of one thing. There's no way to stop the contagion from spreading to everywhere else. And that's how you get a full systemic unwind of the financial system. Again, the trusts, the banks, and the stock market. And this part is very important, okay? Because in 1907, the safeguards around the economy were not what they are today in 2026. There was no FDIC. Okay, FDIC today, if you put money in a bank up to $250,000 is insured by the US government. You cannot lose your money if you have 250K or under in the bank. So it was implemented partly because of crises like this, right? If I know the US government's backing my money, I'm not in a hurry to cause a bank run by rushing to get my funds out. They're backed, okay? There was also no Federal Reserve. We often call the Federal Reserve the lender of last resort because that's exactly what they are. When nobody else has liquidity, we saw this in 2020 when COVID hit. Liquidity dried up. Banks did not want to make loans. Everyone was hoarding cash, just like in 1907. Okay, this is why we talk about human psychology so much in our podcast. The characters change, the economic conditions, companies change, but the psychology does not. In a crisis, people pucker up and they hoard cash. And that's why we have the Fed now. When nobody else wants to lend, they can dump money into the economy to get things started again and get economic activity happening. Once this change starts in 1907, there's nothing to stop it because there's no FDIC and there's no Federal Reserve. All we have is the private sector. So this is the most important question here, back to our main character, JP Morgan. Because Morgan did not act blindly. As we know, he did not just throw money around and throw good money after bad. He had accountants and bankers reviewing the books. And as we mentioned a couple episodes ago, he famously, whether there's a little bit of myth in this or not, supposedly could spend 10 minutes looking at a company's books and know if they were worth saving or not. Whether that's true or not, that's for you to decide, but we do know he was very good at reviewing these books and very quick. So his accountants and his bankers and JP himself, what they saw assets that exceeded liabilities, okay? This is when it comes to the trust company that they are reviewing, okay? Assets exceed liabilities. That's a good thing, okay? Deposits were backed, at least on paper. Okay, they weren't backed by cash in the vaults, but they were backed on paper. Okay, so the way to think about this, if your assets exceed your liabilities, just in a very simple terms, if you have a home that's worth $500,000 and you have a loan on it for $400,000, right? Your asset exceeds your liabilities by $100,000. And so because the deposits were backed on paper, the losses were not catastrophic. And so the issue here was not insolvency. Okay, JP Morgan, if he finds that a company or a bank is insolvent, he lets it die. This was not the case here. The issue was liquidity. They had assets, but they could not turn the assets into cash fast enough, which is a classic banking problem. Like we said earlier, banks do not keep enough cash on hand in order to pay everyone out if they all rush the bank at once, which is why Morgan made the call here. The Trust Company of America is worth saving. Now think about the decision. Morgan is saying, put money into this institution. But from Baker or Stillman's perspective, they don't fully trust the books. They're already under massive pressure at their own banks. And they could lose potentially everything, or at least a lot of capital, which is already in short supply if they are wrong. So the real fear was that because they had just been through what happened with Knickerbocker and saw what happened there, what if this is just Knickerbocker all over again? So this wasn't just a case of these other bankers like Baker and Stillman being greedy. It's also just survival instinct. And so here's where JP Morgan lays down the law. He removes the option to further delay. He has the bankers stay at his library, that iconic library in Midtown Manhattan. No leaving, no deferring, no waiting around, because in a panic, delay can be deadly. You have to act quickly and decisively. No kicking the tires, no let's talk about it next week, no let's see what happens. Sometimes you just gotta open up the money bazooka, if you will, the J. Powell money machine go burr, and you have to force the decision into the present. And so after hours of pressure and negotiation, a solution forms at the library. The banks agree to provide roughly $8 to $10 million initially and with additional backing as needed. And that's an important part. There is not just the initial money, just the optics or the press release of being able to say there's additional backing if needed. That puts confidence into the system. And at the end of the day, this is a confidence game. Bank runs are created because people panic. They rush the bank and then they hear about others doing it, and it compounds on itself. That effect goes in the opposite direction as well. Okay, if they hear that all this cash just got infused into these banks, then their neighbor says, "Oh, you hear about this? The bank is recapitalized. We don't need to rush it." This stuff spreads via word of mouth, and fear can come into the system very quickly when one institution goes down. But confidence, especially when a name like JP Morgan is involved, that can come back quickly as well. So why these bankers that all have different incentives and different people to answer to, why did they agree? What made them agree to do this? It's not really because Morgan convinced them emotionally, because he hadn't changed the equation. He had to present this in a very pragmatic way. You're talking to heads of large financial institutions who are looking out for their own institution. And that's not a bad thing. In fact, they have a fiduciary duty to their shareholders to do that. It's not their job to look out for another trust or even for the system as a whole. Their job is to look out for their own institution. But the way Morgan presented this was, if you don't put in $1 million now, you may lose 10 million later. And this is so powerful when it comes to negotiation or the art of influencing people for my Dale Carnegie followers out there. You have to present things in terms of how they help your counterparty. All this bluster about, we have to do it, it's the right thing, that doesn't work. Morgan had to make these other bankers feel like the problem that they were all working to solve together was existential. And if they didn't work together on it, everyone would pay the price. So these bankers, this is a critical point, they were not acting altruistically. They were minimizing losses. And a lot of the discussions reportedly, I wasn't in the room, revolved around who contributes what, how much exposure each bank already had, and whether others would commit. It's a classic coordination problem. And once enough players agreed, the rest tend to follow. It's like when you're in a meeting or something and the person running the meeting asks a question, and it's kind of awkward to raise your hand, and then one person raises their hand and then the rest of the room does it all together. I mean, this is the effect that JP Morgan had on people. He's just a classic leader of men. We talked about, he's physically imposing, big, in a day when humans weren't as large. He's over 6 feet tall, 250 pounds, big barrel chest, the bulbous nose, the iconic mustache, just an absolute bull of a man, if you will. And he had a way of rallying people. And he was a man of few words, but he got his point across. So once the capital was committed, withdrawals slowed, okay? Confidence was reinstored in the financial system. Confidence stabilized and panic paused. Not necessarily because the fundamentals changed overnight, but because perception changed. Just the idea the system is being supported and the biggest names in finance are behind it. And in a panic, that is everything. So Morgan didn't just inject capital, he forced alignment. He took a fragmented system with multiple players with different incentives, and he made it all act like one. And in a world without a central bank, the Fed, Morgan became the central bank. Next episode, the final rescue. Because even after this, the system still wasn't fully safe.